Oversight and Investigation Subcommittee will come to order. Without objection, the chair is authorized to declare a recess of the subcommittee at any time. Without objection, members of the full committee, not on this subcommittee, are authorized to participate in today's hearing. As a reminder, I ask all members to keep themselves muted when they are not being recognized to minimize disturbances while members are asking questions of our witnesses. The staff have been instructed not to mute members except where a member is not being recognized and there is inadvertent background noise. Members are reminded that all House rules relating to order and decorum apply to this remote hearing. Members are also reminded that they may participate in only one remote proceeding at a time. If you are participating today, please keep your camera on. And if you choose to attend a different remote proceeding, please turn your camera off. If members wish to be recognized during the hearing, please identify yourself by name to facilitate recognition. The title of today's hearing is Consumer Credit Reporting, Assessing Accuracy and Compliance. I now recognize myself for 3 minutes to give an opening statement. It is my honor to convene this hearing styled Consumer Credit Reporting, Assessing Accuracy and Compliance. This hearing will examine the role of the 3 national credit rating agencies, I will call them NCRAs, in the consumer credit reporting system that affect the lives of virtually every adult in the United States. Whether in assessing credit, employment, housing, insurance, or even utilities, the information provided by the major NCRAs has the power to either open or foreclose a vast array of opportunities that undergird economic security and social justice for consumers. Yet, once again in 2020, consumers complained to the CFPB about NCRA reporting more than any other subject, outpacing complaints about credit repair, debt collectors, mortgage servicers, credit cards, bank accounts, surpassing complaints about predatory lenders, payday loan title loans, and usury. The number of NCRA-related complaints in 2020 was over 319,000, nearly double the number in 2019. So many, in fact, that for the first time, the CFPB will be issuing a separate supplemental report to Congress dedicated to this class of complaints alone. While this trend alone calls for oversight, the CARES Act imposed new protections for consumers with respect to credit reporting. Hence, this hearing will provide a timely window into the degree of compliance by the NCRAs with CARES Act mandates and whether additional protections are needed. I look forward to hearing from today's witnesses about what's causing the increased level of complaints, whether rising complaint levels are likely to continue, what has been done and what remains to be done to address the elevated levels of complaints, the potential benefits afforded by alternatives such as a federal credit bureau as proposed by President Biden, whether comprehensive reforms are needed, and whether consumers need more control over their data. I'd like to thank the staff for the outstanding work that they've done to help facilitate this hearing. I'm grateful to the chair of the full committee, the Honorable Maxine Waters, for all of the effort and energy that she puts into all of these hearings and moving us forward. And finally, I want to thank the witnesses again for appearing today and my colleagues who are with us as well. I thank all of you. And at this time, I'm going to recognize the ranking member for his 5-minute opening statement. Mr. Barr is recognized.
Thank you, Mr. Chairman. I appreciate you holding this hearing today, and thank you to our witnesses for appearing before the committee. I look forward to your testimony. The allocation of credit is the lifeblood of the American economy. Lenders, insurers, and other financial firms rely on accurate credit reports to reflect the potential risk of a customer, and consumers expect that their credit reports are fair and appropriately reflect their financial histories to ensure they may access financial products at competitive prices. Mechanisms exist for consumers to file a complaint or to dispute an inaccuracy in their credit report. The Fair Credit Reporting Act directs the CFPB to submit an annual report about complaints to Congress. In the most recent report, the CFPB stated that prior to COVID-19, the average number of complaints were approximately 300,000 per year, but in 2020, there were approximately 542,300 complaints, a 54% increase from 2019. I look forward to learning more today from our witnesses about the potential causes for an increase in complaints and what the credit reporting agencies are doing to address them. In March of last year, Congress acted to ensure that consumer credit histories were not adversely impacted as a direct result of the COVID-19 pandemic and ensuing economic challenges. As part of the CARES Act, Congress amended the Fair Credit Reporting Act to ensure that consumers were protected during the pandemic, clarifying that accommodations made by lenders or other creditors for customers were not included as negative entries on their credit reports. The credit bureaus themselves made additional accommodations to serve customers during the pandemic, and I look forward to hearing more about their activities during today's hearing. Despite many advancements and innovations in financial services, a staggering number of Americans remain unable to access credit. A recent study by the Federal Reserve Bank of New York found that at the end of 2018, approximately 26.5 million adult Americans, or roughly 10.5% of the population, were not in the formal credit economy and thus did not have a credit history. This so-called credit invisibility disproportionately impacts consumers in rural areas and can perpetuate the cycle of reduced access to traditional financial services. While many consumers may not have traditional credit histories, they should be able to leverage alternative examples of their financial health. On-time payment of cell phone bills, rent, utility bills, and other payments, and other alternative data are indicative of a consumer's ability to repay. I hope to learn more about how the credit bureaus are innovating to account for this alternative data and the outlook for expanding credit availability to underserved or credit invisible individuals. Unfortunately, some on the other side, including the president, are using imperfections in the current credit reporting landscape to push for radical solutions that would increase prices for consumers, limit competition, and make credit less available, especially for low and moderate income borrowers. The Biden administration has proposed eliminating the private sector credit bureaus and replacing them with a centralized, nationalized credit reporting bureau run by the CFPB. While the current credit reporting system is not perfect, nationalizing the process and thus eliminating all incentives for sound customer service and innovation will leave consumers further behind. Appropriate government oversight of the credit reporting agencies and private sector innovation are the most effective means to reduce credit data errors and bring about a more inclusive credit system. We've also heard a growing chorus of my colleagues on the other side calling to eliminate risk-based pricing in financial services. But risk-based pricing in credit allocation, insurance, and other financial products is essential to ensuring that consumers are paying the appropriate price for their products. Firms are adequately managing risk, and allocation of credit is not arbitrarily limited based on onerous, one-size-fits-all restrictions. Firms are prohibited from pricing risk based on race, nationality, religion, or other demographic characteristics, instead focusing on the metrics that demonstrably reflect and accurately reflect a consumer's ability to repay. A recent study from the U.S. Chamber of Commerce illustrates that eliminating risk-based pricing and replacing it with a uniform pricing model would raise prices on consumers and limit availability of credit and other financial services to low and middle income borrowers. A prohibition on using predictive data would not make the system more equitable, but instead dramatically exacerbate the inequalities we all hope to eliminate. I look forward to discussing these important topics today. And Mr. Chairman, on a personal note, this will be my last hearing as ranking member of the Oversight Subcommittee as I move on next month to serve as the ranking member of the National Security and Monetary Policy Subcommittee. It has been a pleasure serving on this subcommittee with you. Thank you, and I yield back.
The gentleman yields back, and the chair would like to, if I may, briefly state that I've enjoyed working with you as well, and I'm sure we'll find additional opportunities to work together. Congratulations on your new station in life. Now the chair would recognize the chairwoman of the full committee, the gentlewoman from California, the Honorable Maxine Waters, for 1 minute. You may be on mute, Madam Chair. We may be having some technical difficulties. While we examine our technology to ascertain whether we're having such difficulties, please allow me now to recognize the vice chair, a person who has been a friend for some number of years, the gentlewoman for Georgia, for 1 minute.
Thank you, Mr. Chairman, and I am honored to be serving in my first hearing today as Vice Chair of the Oversight and Investigation Subcommittee. On this subcommittee, we consistently uplift those most marginalized, something that I strive for in all that I do in Congress. We uncover the information needed to inform better policy and oversee that government agencies and programs are indeed working for the people. I'm grateful for the opportunity to help lead the important work of the Financial Services Committee's investigative arm. And today we'll take a deep dive into credit reporting. An individual's credit score can determine whether they can do things like buy a house or start a small business, or more broadly, build a better life for themselves and their families. To help hardworking folks get ahead in the wake of this pandemic, ensuring credit reporting is fair, accurate, and consumer-friendly will be of utmost importance. I look forward to hearing from our witnesses today and working together with my colleagues on this important issue. And Mr. Chairman, thank you, and I yield back.
The gentlelady yields back, and the chair neglected to congratulate the gentlelady for her new station in life. I commend you and do look forward to working with you as well. The chair will now introduce the witnesses, and I welcome our witnesses and am pleased to have the opportunity to introduce them. We have with us Ms. Chi-Chi Wu, who is a staff attorney at the National Consumer Law Center. We have Ms. Beverly Anderson, who is president for Global Consumer Solutions at Equifax. We have Ms. Sandy Anderson, senior vice president for strategy and operations at Experian Credit Services. We have Mr. John Danaher, who is executive vice president for Consumer Interactive at TransUnion. And also we have finally Ms. Rebecca Kuehn, who is a partner at Hudson Cook Law Firm. The witnesses are reminded that your oral testimony will be limited to 5 minutes. You should be able to see a timer on your screen that will indicate how much time you have left. A chime will go off at the end of your time. I would ask you to be mindful of the timer and quickly wrap up your testimony if you hear the chime, so that we can be respectful of both the witnesses and the committee members' time. Without objection, your written statements will be made a part of the record. Once the witnesses finish their testimony, each member will have 5 minutes to ask questions. Before I go to Ms. Wu, I have been given an indication that Ms. Waters is now available. Hence, I will recognize the chair of the full committee for 1 minute, and then we will move to Ms. Wu.
Thank you very much, Mr. Green, for holding this important hearing on credit reporting. In February 2019, one of the first hearings I convened as chairwoman was a hearing with the 3 CEOs of Equifax, Experian, and TransUnion. The National Credit Bureaus to examine the ways in which the current system fails to protect consumers. We advanced several bills through the House to fix the broken credit reporting system, but the Senate failed to act. Unfortunately, Consumer credit reporting complaints to the CFPB more than doubled from 2019 to 2020, suggesting a surge in more credit reporting errors during the pandemic. We must learn what is behind these trends and what the credit bureaus must do to protect our consumers. And I thank you very much, and I yield back the balance of my time.
Ms. Wu for 5 minutes to give an oral presentation of your testimony. Ms. Wu, you're now recognized. You may be on mute, Ms. Wu. Ms. Wu.
Thank you, Mr. Chairman. Mr. Chairman, Ranking Member Barr, members of the subcommittee, and Chairwoman Waters, thank you for inviting me to testify today. I'm testifying on behalf of the low-income clients of the National Consumer Law Center. I've been testifying on credit reporting abuses since 2007. Before me at NCLC was Tony Rodriguez. He went on to the CFPB and FTC, and we just celebrated his retirement yesterday. Before him was our former director, Will Ogburn. In fact, the first director of NCLC testified in FCRA hearings in 1969. I mention this because it shows that we've been battling the abuses of credit bureaus for a very long time, and yet it hasn't gotten better. In fact, it might have gotten worse. 300,000 complaints to the CFPB in 2020. That's a lot of complaints, twice as much as last year, nearly 2/3 of the complaints to the CFPB. And of course, according to the FTC's 2012 study, there are 10 million Americans who have errors so serious on their credit reports, it could deny them or cost them more for credit. And no, this explosion in complaints isn't just credit repair outfits challenging accurate information. The CFPB has said there's no evidence of that. The credit bureaus have been blaming credit repair for decades. It's the same old, same old. What's different? A pandemic, of course, with devastating economic impact on many Americans, potentially causing more folks to check their credit reports, which the credit bureaus commendably did make available once per week for free. The CARES Act, with its complicated provisions that some creditors seem to be tripping up on, and a looming rental housing crisis with 8 to 10 million Americans possibly facing eviction. The last issue is another possible reason that complaints have exploded. The fact that nowadays 90% of landlords conduct credit checks as part of tenant screening, pushed by the credit bureau's expansion into new uses and thirst for more customers and more sales. An article from this past Sunday's New York Times documents how millions of Americans are being shut out of stable rental housing by credit checks. This article notes how a survey of residents in extended hotels in Norcross, Georgia, 70% of whom were Black, named credit as the biggest barrier for more permanent housing, and 600 students stay at extended stay hotels in the largest school system in Georgia. 600 children without a permanent roof over their heads, in part because of the credit bureaus. Simply put, using credit scores in housing worsens the already terrible economic and racial inequality in our country. And of course, being denied housing provides a great incentive to check your credit report and dispute errors. The credit bureaus only have themselves to blame. The more they hawk their products for inappropriate uses, the more of the 10 million Americans with serious errors are going to find those errors and complain. Speaking of credit repair, the credit bureaus complain so much about it, but according to a recent legal case, they have agreements with Lexington Law, the second biggest credit repair firm. If they complain about it so much, why do they have agreements in it? By the way, the CFPB sued Lexington Law for deceptive advertising. If you don't believe me that the explosion of complaints is not illegitimate credit repair, check out the narratives in the CFPB Complaint Database and read for yourself. We've highlighted a few in our written testimony. Here's an example. In addition to TD Bank posting the account as paid in full, they reported me as deceased. I wouldn't have known this except I was trying to get a mortgage and my bank told me that Experian and Equifax showed me deceased based on TD Bank's report. The consumer goes on to say, I called X and X, but also could not prove to them to their satisfaction, despite answering all their questions as to my identity, that I am in fact alive. I was unable to get the mortgage due to these errors on my credit report and the inability or unwillingness of these companies to correct their errors. One reason why credit bureaus might actually not mind credit repair or this huge volume of disputes is that they actually don't do a heck of a lot when they get a dispute. They've automated the heck out of the system to the point where when a consumer disputes online, it automatically flows to the information furnisher with no need for work by the credit bureaus. Even for paper disputes, the main job of offshore vendors to handle these disputes is to pick a 2 or 3 digit code to categorize this dispute, maybe add a line of text, upload documents, and send it to the furnisher. For non-existent or very little work on most disputes, the automated system used for processing disputes, called eOscar, charges 30 cents per dispute. Well, as you can imagine, more disputes, more fees. Always follow the money. It's time for a public credit registry that will treat Americans fairly, fix disputes, and not try to expand credit reporting to every conceivable aspect of American life, however inappropriate. I thank you for the opportunity to testify and look forward to your questions.
Thank you, Ms. Wu. The chair now recognizes Ms. Beverly Anderson for 5 minutes to give your oral presentation of your testimony.
Chairman Green, Ranking Member Barr, and members of the subcommittee, and Chairwoman Waters, thank you for the opportunity to testify today. I am Beverly Anderson, President of Global Consumer Solutions, and I am responsible for providing free and paid credit and identity products, services, and education to consumers. I want to recognize that credit reporting accuracy is a common priority that Equifax shares with consumers, lawmakers, regulators, and financial institutions. Under the Fair Credit Reporting Act, consumer reporting agencies and data furnishers must meet stringent requirements for accuracy, fairness, and privacy. I have a personal passion to support financial inclusion and a professional responsibility to assist consumers as they consider the most significant financial decisions. I understand how frustrating it can be for a consumer to be on the cusp of an exciting financial event only to discover an issue with their credit report. When I hear these stories, it strengthens my resolve to do better. The increase in complaints against Equifax through the Cfpb Consumer Complaint Database is concerning. I interpret the increase not as an indictment that the credit bureau system is broken, but rather as evidence that the national credit bureaus play an important role in facilitating the dispute process between consumers and their creditors. Let me briefly review 3 factors to contextualize the increase in complaint volume. First, consumers submitted more complaints against the national credit bureaus through the CFPB portal as the CARES Act protections appeared on their credit reports. The COVID pandemic presented an extraordinary set of challenges for American consumers. Congress moved quickly in early 2020 to pass the CARES Act that included new consumer protections such as mortgage forbearance, eviction moratorium, and a pause on student loan payments. As a result, lenders took swift action to comply with the new CARES Act provisions and data reporting requirements. With the combination of consumer economic uncertainty and the implementation of new accommodations, consumers reviewed their credit reports more often. Second, consumers routinely submit complaints to the CFPB that are not complaints about credit bureau actions, but rather disputes about data reported to us. Consumer reporting agencies serve as an intermediary between consumers and their lenders. Our data show that 95% of portal complaints involve disputes that typically relate to information provided by a lender, an outdated address, or a credit score. Therefore, most complaints against the national credit bureaus in the CFPB portal should not be attributed to errors made by the credit bureaus. And third, the portal has been inundated by submissions from credit repair organizations disputing adverse but accurate information on consumer reports. Recent internal Equifax reviews indicate that 65% of complaints in the portal appear to be associated with credit repair organizations. Let me close my opening remarks by reviewing Equifax's efforts to assist consumers through the pandemic. In April 2020, and at my direction, we quickly launched a COVID and Credit Financial Resource Center to help consumers understand and evaluate the impact of the pandemic on their finances. I personally conducted public webinars and recorded podcasts to assist consumers. As the pandemic took hold, 3 national credit bureaus collectively decided to provide consumers with free credit reports each week. And in March of this year, we extended that initiative through April of 2022. Equifax continues to invest millions of dollars to deliver exceptional care to consumers in our quest to become the most consumer-friendly CRA. We modernized our telephony and back office infrastructure. We've automated core processes, expanded call center hours, and upskilled our agents. My goal is for Equifax to be accessible, responsive, caring, and efficient at every touch point in a consumer's engagement. I am proud of the work that Equifax has done to assist consumers through the pandemic, and I pledge to do more. I look forward to answering your questions. Thank you.
Thank you, Ms. Anderson. Ms. Sandy Anderson, you are now recognized for 5 minutes to give an oral presentation of your testimony.
Thank you, Chairman Green, Ranking Member Barr, Chairwoman Waters, and members of the subcommittee. I am Sandy Anderson, Senior Vice President of Operations for Experian North America. Let me begin by stating why credit bureaus exist and how consumers benefit. Credit bureaus accurately compile individuals' payment histories reported to us by creditors so that lenders can use this data to make sound underwriting decisions. Sound lending decisions for credit cards, autos, and mortgages mean fewer defaults. Fewer defaults mean lower cost of credit for consumers and greater availability of consumer credit across the economy. Credit bureau data is blind to factors such as race, ethnicity, and gender, so it helps lenders ensure compliance with the Equal Credit Opportunity Act. What we hear most often from consumers and policymakers is that they want us to focus on 3 clear objectives: ensure the information we hold on consumers is secure, make credit reports accurate, and manage a data dispute system that is easy for consumers to access and use. Experian wholly understands these responsibilities and has significantly shifted its focus to the consumer. Experian has kept pace serving consumers during the COVID-19 pandemic and will continue as our nation's economy recovers. We have responded completely and accurately to all consumer complaints to the CFPB complaint portal. We believe most of the increase is due to third-party credit repair shops that file disputes on accurate but negative information to try and game the system. The number 1 priority at Experian is keeping consumer information safe and secure, and we are working on our own initiatives and with our regulators under continuous supervision on this priority. Experian supports this committee's goal of enhancing the accuracy of credit reports and improving the dispute resolution process. We believe the best way to achieve and maintain improvements on behalf of consumers is through a robust and continuous supervision and examination program, which has been administered by the Consumer Financial Protection Bureau in place since 2013. We have implemented many new initiatives as a result. Experian has invested heavily in systems and processes to improve data accuracy as we continually strive to reach 100% accuracy. Stringent requirements are in place to identify and eliminate inaccurate data submitted monthly by approximately 10,000 data furnishers before it is included in a consumer's file. Experian provides data furnishers with monthly reports describing any of their data we have rejected and why, and providing them with historical information about their data contributions and consumer dispute performance. Through this transparent feedback loop, Experian is making continuous progress in eliminating errors even before data is submitted to us. An important component of accuracy is to make credit reports accessible for consumers so that they can easily review and dispute errors in their file. Experian's online dispute portal, including a mobile, optimized, and highly rated app, makes it easy for consumers to submit disputes and to receive the results of those disputes. Experian also supports the committee's goal of creating more opportunities for financial inclusion and financial literacy for consumers thought of as credit invisible. Many consumers may not have a mortgage or credit cards, but they do make telephone, utility, and other recurring monthly payments. Experian is now accommodating this data through a groundbreaking product known as Experian Boost. We are delivering this data directly to lenders so that they can expand their efforts to reach underserved consumers. Experian Boost is a game changer. It allows consumers to safely and easily opt in to having monthly payment information on accounts that are not reported to the CRAs included directly into their credit file. Experian Boost is particularly helpful to consumers who are new to credit or have had financial challenges. So far, more than 6 million consumers have chosen to use Experian Boost to improve their credit score. To help improve financial literacy, Experian is also providing access to free credit monitoring, free credit reports, free credit scores, and financial education to more than 40 million US consumers. Experian is also partnering with lenders through the OCC's Project Reach initiative to identify new sources of predictive data that can be used to improve access to credit for underserved and marginalized consumers. Thank you for inviting me to testify, and I look forward to answering your questions.
Thank you, Ms. Anderson. Mr. Danaher, you're now recognized for 5 minutes to give your oral presentation of your testimony.
Chairman Green, Ranking Member Barr, Chairwoman Waters, and members of the committee, thank you for the opportunity to participate in this afternoon's discussion of these critical policy issues. My name is John Danaher, and I serve as president of TransUnion's Consumer Interactive business. TransUnion is a global information and insights company headquartered in Chicago with more than 4,000 employees in the United States and 8,200 worldwide. We seek to help people around the world through the power of information, identify and access opportunities that bring a higher quality of life. Our Consumer Interactive segment helps consumers manage their personal finances and take precautions against identity theft. We provide consumers with credit scores, credit reports, credit monitoring, fraud prevention and support, and financial management tools. We also provide credit monitoring solutions that help businesses respond to data breach events. Our direct-to-consumer products help Americans achieve financial freedom and elevate their lives. The past 14 months were unlike any in our history, and we believe all of us must work together to protect and support consumers. TransUnion recognizes our central role in ensuring the fairness and stability of our nation's consumer credit markets, and we are eager to partner with this committee to help all consumers, especially the most disadvantaged Americans and those affected by the pandemic. The pandemic required novel and significant consumer support efforts, both from the private sector and the federal government. At TransUnion, we immediately pivoted our workforce to remote servicing while still providing consumers the necessary support they needed to navigate the pandemic. Our data indicates that both lending and the broader economy are normalizing, but serious challenges continue to persist for many consumers. Helping consumers affected by the pandemic secure the financial protection they need has been and continues to be one of our top priorities. We are regularly communicating with lenders, property management firms, scoring companies, and data furnishers on how they can provide relief to customers through established hardship programs. It is incumbent on our industry to support the policy objectives of the Bipartisan CARES Act, and we are pleased the accommodations provisions at the core of that law are working. We estimate more than 200 million consumer accounts have been placed in protective accommodations because of the CARES Act. At the onset of the pandemic, TransUnion led the effort to expand the availability of free credit reports to all consumers on a weekly basis. We are proud to report that more than 166 million consumers have used our services to access their credit data. It is undeniable that the pandemic is exacerbating pre-existing structural inequalities. with underrepresented Americans facing unique challenges. We are striving to address matters of racial equity and want to be at the vanguard of defining consumer-focused principles for the next generation of data use. To that end, last year we launched TransUnion's Task Force on Racial Equity, which I lead. As part of this work, we are ensuring that all uses of TransUnion's products and solutions are consistent with our values and the goal of financial inclusion in the economies we serve. We are also redoubling our efforts supporting the proliferation of alternative data, which is the most direct way to expand credit to historically disadvantaged groups. Notably, we are working with the OCC on its Project REACH efforts. TransUnion believes alternative data is a racial justice issue. Millions of underrepresented consumers make rental, utility, and other payments every month, yet the current system gives them no credit, often rendering them credit invisible. TransUnion is committed to helping Americans protect their financial health during and after the pandemic. We look forward to working with Congress to foster financial inclusion and further empower consumers. I appreciate the opportunity to be with you today and look forward to answering your questions.
Thank you, Mr. Danaher. Ms. Kuehn, you are now recognized for 5 minutes to give an oral presentation of your testimony.
Chairman Green, Ranking Member Barr, Chairwoman Waters, and members of the subcommittee. Thank you for the opportunity to appear before you today to talk about the consumer reporting industry's commitment to the accuracy of credit reports. My name is Rebecca Kuehn, and I am a partner at Hudson Cook, where I chair the Credit Reporting, Privacy, and Data Security Practice Group. I'm appearing today on behalf of the Consumer Data Industry Association, or CDIA. CDIA represents the nationwide credit bureaus, regional and specialized credit bureaus, background check and residential screening companies, and others. The credit reporting agencies here today and the CDIA members help the American consumer and the larger economy by maintaining a robust consumer reporting system that facilitates credit, employment, and housing transactions nationwide. CDIA members are helping to solve the problem of the unbanked and credit invisible populations through innovation by expanding the kinds of data collected, such as rental history or payments on telephone or other utility bills. This expansion gives lenders and others information that allows more consumers to access traditional financial services and to integrate more consumers into the mainstream financial system. The principal law that governs the consumer reporting system is the Fair Credit Reporting Act. The FCRA requires consumer reporting agencies to follow reasonable procedures to assure maximum possible accuracy of the information in consumer reports. The maximum possible accuracy standard is not one of perfection, but it balances the protection of consumers and the needs of commerce. The FCRA recognizes that accuracy begins with the data coming into the system. The lenders who provide that data, the furnishers, must have reasonable policies and procedures to ensure the accuracy and integrity of the information they provide to consumer reporting agencies. The FCRA also gives consumers the right to dispute the accuracy of information directly with those furnishers. To assure accuracy, the consumer reporting agencies then screen lenders before they even onboard them as furnishers, and furnished data undergoes a number of checks and quality control measures before it is added to a credit file. The nationwide consumer reporting agencies obtain information electronically using a standardized reporting format to facilitate the accurate and consistent reporting of data throughout the system. The FCRA also provides consumers with the right to access information about them and to dispute any inaccuracies. This dispute process is an important and necessary component of ensuring accuracy. For this reason, the nationwide consumer reporting agencies have made significant investments in consumer dispute resolution to make it easier for consumers to identify and correct potential errors in their files. These improvements, which are outlined in my written testimony, include an escalation process for addressing disputes related to mixed consumer files and identity theft. It also is important to recognize that there is a market incentive to ensure maximum possible accuracy. The customers of the credit bureaus, financial institutions, and their regulators rely on and demand accurate data to make critical decisions about credit. That demand drives accuracy. In my written testimony, I addressed the number of credit reporting complaints to the CFPB and why those are not a good measure of accuracy, particularly given the impact of bad actors, credit repair operators, on the numbers of complaints. I'll be happy to address any question the subcommittee has. But with my remaining time, I want to turn to the protections that Congress enacted in response to the COVID-19 pandemic. The CARES Act, passed in March 2020, implemented a number of significant protections for consumers, including special credit reporting changes and payment deferrals. These changes allowed consumers to preserve their credit history while they worked through the challenges of the pandemic. And the data shows that the impact of these protections has been significant. The number of missed payments have gone down, and the national average score, FICO score, went up during 2020. The 3 nationwide consumer reporting agencies have resources on their website to inform consumers of their options and protections under the CARES Act, along with other resources that are available to help them manage their credit during the pandemic. In addition, the nationwide consumer reporting agencies have voluntarily increased the number of free reports available to consumer from once per year to once per week through April 20 of 2022. As we emerge from the pandemic, CDIA and its members are committed to providing consumers with the tools they need to manage their financial future. I thank you for the opportunity to testify before you today, and I'll be happy to answer any questions.
Thank you, Ms. Kuehn. The chair will now recognize members for 5 minutes questions. I now recognize the gentlewoman from California and the chair of the full committee for 5 minutes for question.
Thank you very much, Congressman Green. I'm going to address this question to Ms. Beverly Anderson. Following enactment of the CARES Act, you said, and I quote, "It will take a moment to figure out how to execute against what's been stipulated by the CARES Act. So something's bound to slip through the cracks," end quote. Earlier this year, the Subcommittee on Consumer Protection and Financial Institutions held a hearing called Slipping Through the Cracks, which provided a number of legislative solutions to help America's consumers in the pandemic. We cannot accept that consumers will simply slip through the cracks. So let me give you one example we heard at the subcommittee hearing. Carla Sanchez Adams, managing attorney for Texas Rio Grande Legal Aid, said, and I quote, "Many of our clients who have been treated for the virus have expressed concern over medical debt collection and insurance coverage. Ms. M had a medical debt account appear on her credit report for treatment her grandson received. She was also contacted by debt collectors regarding the same medical debt. Ms. M's grandson was covered by Medicaid, and under Texas law, neither Ms. M nor her grandson were responsible for costs of any medical services provided to them. However, the debt collectors continued to collect on the debt and report the debt," end quote. So this grandmother's credit was harmed through no fault of her own. While her grandson was getting medical treatment, he was covered for it. It should not be complicated, and consumers should not have to get a lawyer every time someone makes a mistake that shows up on their credit report, making it expensive for them to get a loan, among other harms. Yes or no? Is Ms. M's case what you mean by saying, quote, "something is bound to slip through the cracks," end quote?
Thank
Go right
you,
ahead.
Chairwoman, for your question. Thank you, Chairwoman, for your question. I appreciate the fact that you have listened to one of my podcasts or a webinar. And what I was simply stating, and remember, this was early days of the pandemic. Consumers were literally asking us questions about the various stipulations and protections in the CARES Act. They wanted to know how the CARES Act would protect them, what things might change, what things would be different on their credit report. And we were simply articulating that there might be things that are confusing. And
Okay, thank you, reclaiming my time. Thank you very much, reclaiming my time. What have you done to ensure that people are not simply falling through the cracks? What have you done to rectify that, to lessen the number of mistakes that you make? Because this is what's harming our consumers, the mistakes, and you can't correct them once you do it, and we don't get a lot of help from the credit bureaus. What have you done new?
Data accuracy is an important part of
Yes,
of
we
our
know that.
mission,
What have you done? What have you done?
as is with data furnishers. And so since 2012, we have been actively involved in addressing issues of accuracy. In terms of the way in which we work with furnishers, we have an entire team who spends time vetting furnishers, vetting the data that they provide us, and creating remediation plans, quality controls, and monitoring. And if a furnisher, in fact, fails to meet our standards of data quality, we will prevent them from reporting.
That's
data
good,
to us.
very
We've
good.
clarified-
Reclaiming my time. How effective have you been? And how much reduction have you had in these kind of falling through the cracks instances?
We know that we've made considerable progress, and we know that there's
How do
more
you
to
know
do.
that?
We monitor all of the data that we receive, and we make sure that we're checking accuracy at every turn.
Give me some numbers. What's different now than before?
We know that we have created an opportunity for consumers.
How do you know?
To have,
How do you know?
because
we don't have much time. That's why I have to take back my time. But I want to know how you're able to define that you have been effective.
We look at metrics in a number of ways, and would be happy to bring some of those metrics back and share them with you.
Thank you very much, Mr. Chairman. I'm going to ask that Ms. Anderson send us back some information and some reports that's showing that they have reduced or eliminated the number of mistakes that cause people to fall through the cracks. I yield back the balance of my time.
Gentlelady yields back, and without objection, the question will be submitted to Ms. Anderson for her reply. At this time, the chair recognizes the ranking member, Mr. Barr, for 5 minutes for his questions.
Thank you, Mr. Chairman. First question is about risk-based pricing. Lenders, insurers, and other financial market participants rely on risk-based pricing for their products and services. They use data indicative of a consumer's ability to repay, blind of race, nationality, or religion, or other immutable characteristics to give consumers the best price. Ms. Kuehn, would you discuss the importance of risk-based pricing in financial services, and specifically, what impact would a government-imposed prohibition on risk-based pricing or a mandate for using use of uniform pricing have on the price, availability, and access to financial services?
Thank you, Representative, for your question. The studies that have come out focused on risk-based pricing have shown that if we abandon risk-based pricing, that will result in an overall increase in the price of credit and a lessening of the availability of credit for consumers. Risk-based pricing has enabled more consumers to qualify for credit, even if traditionally they would have been declined. If we reverse this course, there will be fewer consumers who qualify for credit.
Well, thank you for that. And I do worry about proposals that would politicize the assignment of credit scores based not on accurate data, but on other factors that could be politically motivated. That would, as you point out, increase the cost of credit for everyone. Let me talk about President Biden's proposal for a federal credit bureau. As you all know, and as has been pointed out today, President Biden proposed eliminating private credit reporting agencies and replacing them with a public government credit bureau within the CFPB. I believe this is an unnecessary federal takeover of a private industry at the expense of taxpayers. Ms. Kuehn, what are some of the issues that you foresee with a single government-run credit bureau? And please amplify your testimony that I thought was a point well taken about the market incentive that exists currently to maintain and improve the accuracy and completeness of credit reports?
Thank you, Representative. From my background at the FTC, I am very pro-competition, and the current market now has 3 large credit reporting bureaus who compete with each other for accuracy and on other products and services and innovations. We believe that a government-run credit bureau would not have those same incentives to find new solutions for consumers or expand access. The proposal today for the government-run credit bureau would leverage the same data that's here already in the system. Our members are looking for new and different sources of data, and that type of innovation fuels additional entrance into the credit market. In addition, we take issue with this concept that the government-run credit bureau would be more answerable to consumers. Under the current system, consumers have not only the right to dispute, but they also have significant private causes of action that enable them, if all else fails, to bring private lawsuits against the credit bureaus and obtain money at court. It is unclear whether the government-run credit bureau would be similarly answerable to consumers when problems occur. And they do when you deal with large sets of data, sir.
Ms. Kuehn, that's a good point about being responsive to consumers, but I'm also worried about the politicization that could happen with a single government bureau. We've seen that with the CFPB itself. And so the accuracy of information based on just data and not other extraneous factors, I think, is really, really important. Finally, alternative data, and I'll ask Ms. Kuehn, but any of the representatives of the CRAs can chime in because of the innovations that are happening in terms of alternative data. I think Experian Boost is an example of this. Mr. Danaher, you had an interesting a piece of testimony about what is the let's see, I highlighted the Credit Vision Suite. I thought that was very interesting and innovative. How would utilization of this data by credit reporting agencies help Americans gain access to credit?
What we've seen so far, go ahead.
Go ahead.
Sorry. What we've seen so far, Representative, is that it reaches more consumers. For those who don't have a traditional credit history, these alternative data sources act as good history they can build on to further their credit goals. And so for folks like new entrants to the credit market, be it younger Americans or immigrants, we're able to leverage this information that they already have and turn it into credit information. Thank you.
My time has expired, but I love this private sector innovation on financial and credit inclusion that I doubt a government agency would ever be able to do. I yield back.
The gentleman's time has expired. The chair now recognizes Ms. Tlaib, the gentlelady from Michigan, for 5 minutes of questions.
Oh, thank you so much, Chairman. I really do appreciate this incredibly important hearing, especially because so many of our families are directly impacted by the way credit reporting is conducted now. And so I do have some questions for everyone on the panel, and I think this is so important because credit reporting, the initial intent of credit reporting was for lending, and now it's impacting access to transportation. It's also the leading cause for many of our veterans, who really come back from serving our country with no access to credit because they weren't here to spend or to apply for credit cards or whatever the, whatever the processes that these private agencies decide related to what a credit score is. So my question is to many of those on the panel, what does a credit score have to do with someone's driving record, whether or not they're a good driver? Does anybody know the answer to that question?
I would thank you for the question, Congresswoman Tlaib. It's an excellent question, and I would say absolutely nothing. A credit score should be used for one thing only, and that's credit. It doesn't have anything to do with your driving, with your ability to do a job as a worker, with your honesty. It has nothing to do with your character. It predicts whether there's going to be a 60-day late in the next 2 years, and it shouldn't be used for housing. It is shutting out so many low-income Americans from permanent housing, as the New York Times documented in a very heartbreaking manner.
Yeah, Ms. Wu, Yeah, and Ms. Wu, you should know, and many of folks, I would love to hear their answers too. You know, University of Michigan did a wonderful study showing that it actually kept people in a cycle of poverty, that the fact that credit scores are now being used for, auto insurance, which right now in my district, we have the highest in the nation, over $5,000 average per household. And so for many of my frontline workers, many of my teachers, who some have second jobs just to pay for auto insurance, because again, the use of the credit score is a heavy weight on the calculation and the rates of auto insurance. Does anybody else know, what does the credit score have to do with somebody's driving record? Why is that being considered? Why are you all reporting credit scores to auto insurance industries other than making money?
Thank you, Representative, for your question. The FTC actually did a study on credit-based insurance scores following the FACT Act in 2003. And in its look at the use of credit in insurance determinations, found that there was a correlation between the way someone pays their bills and whether or not they're going to cost more as an insurance.
So if they can't pay their bill, I'm sorry, Ms. So if they're low income and they have a hard time paying their bills, then let's raise the rates on auto insurance. Has nothing to do whether or not they're a good driver. It's let's punish them because they're poor, because they can't afford to pay their auto insurance. That's what I'm hearing when I hear about these studies. But I'm really wondering whether or not you all would support a study of disparate impact of using credit score as a factor for auto insurance rates. Would anybody be opposed to that? Would you want to know if there's structural racism exists in the use of credit scoring for auto insurance? Would you want to know that as a business in the United States?
Representative, the FTC study that focused on credit-based insurance scores looked at that as part of its assessment. And similar to the Federal Reserve study, found that the factors that go into credit scores are neutral. And therefore, and they appropriately risk rank.
Even though it has resulted in more Black folks getting higher rates of auto insurance than their white counterpart neighbors. Do you hear? So the result, so disparate impact, Miss Rebecca
Kuehn.
Miss Kuehn, you see what I'm saying here? The result of it, you can say it's neutral, but the application in itself, and Chairman Green knows that I've been pushing for this study. He knows that this is really critically important to understanding when we say disparate impact. What we mean is it's not direct intentional discrimination, but in essence, by using the credit score for that, it in essence is keeping people in poverty, and that tends to impact communities of color specifically. And it's just ridiculous that someone that is a doctor, this is honest truth, this is true, somebody with a DUI, driving under the influence violation, is paying less insurance than somebody with a bad credit score, not the greatest credit score, even though they don't have a DUI on their record. Do you see this absurdity of it all? Do you understand that my folks that are low income, the ones who are cleaning your hotel rooms, the ones who are putting food on your table at the restaurants, these folks that can't afford, to pay some of the high cost of living in the United States, they can't even pay their water bills. You're telling me let's punish them because they can't afford high rates of auto insurance. Let's go ahead and sell credit reports to auto insurance industries. It has nothing to do whether or not they're going to be a safe driver. It has nothing to do whether or not their car is a safe car, or nothing to do with the length of time it takes them to go from their home to their job. It is absurd that you all stand with that when we all know it's because you get new customers. You get customers, meaning they buy your credit reports from you and you make money off of keeping people in poverty. Do you see what I'm saying? So it's really hard for me to continue to hear these kinds of rhetoric and excuses that come out of these credit reporting agencies. Shame on you. Shame on all of you to keep people in poverty in our country. Shame on you for targeting Black and brown communities, because I see it. That's exactly what you do. And when I see, Mr. Chairman, the last point is so important. When I see the number one issue, the number one reason that we see bankruptcy, personal bankruptcy in our country is medical debt. So I hope this credit reporting agency support our bill that we passed out of Financial Services Committee that bars medically necessary debt, procedures that are needed and required. This is HR 2537, requiring them not to put medically necessary debt on your credit report because they needed it to live. It is not their fault that they got sick. And because they're poor, they shouldn't have, be pushed back and not allowed to get these procedures done. Because you're poor, you shouldn't be able to die in this country. Do you understand? So it is so important, Mr. Chairman, that we continue to have hearings like this to expose the truth. I appreciate and I yield.
The gentlelady yields.
Mr. Chairman, point of order. Could we have?
Excuse me, please, let the chair recognize you first, if you would, please. To whom should I recognize? Who is it that I should recognize?
This is Barr.
Mr. Barr. You're now recognized for your point of order.
Thank you. Just wanted to make sure we're checking the accuracy of the clock. Could you check with the clerk? I think we've had some inadvertent pauses on the time, the countdown on the clock. Could you just check on that, Mr. Chairman?
I will keep an eye on it. Thank you very much for calling it to my attention. And with that said, the chair will now recognize the gentleman from Georgia, Mr. Loudermilk, for 5 minutes of questions.
Well, thank you, Mr. Chair. I appreciate the opportunity to be a participant in this this hearing. It is of importance, and one of the complaints that we sometimes hear about the credit bureau is there's not enough competition. I know many of my colleagues support competition in this industry and have supported legislation and conducted oversight of the FHFA to bring more competition to the credit reporting and scoring. But the Biden administration has proposed eliminating competition by creating another government entity, a government credit bureau. Ms. Anderson of Experian, what would the consequences be if Congress replaced the current system with a government-run credit bureau?
Yeah, thank you for that question, Congressman. We believe at Experian that the system is working. It does drive competition. It does drive innovation and allows us to bring to market solutions like Experian Boost to bring in data that is not part of the existing credit reports and allow consumers to expand that information in their credit report and allow lenders to use that in order to serve underserved and financially challenged consumers. So we believe that this system works with the appropriate level of oversight by the CFPB and that competition drives innovation.
Well, I appreciate that. And using the tools that we need to, it's all about mitigating risk. It's about, lenders want to lend money. That's how they make their profit. Auto dealers, they want to sell cars. That's how they make a living. But the only way that they can do this and do it affordably, in other words, making loans at an interest rate commensurate with the risk, is if they know what the risk is. And in some cases, people will be denied credit or they will be charged more credit simply based on the risk. And so my fear is that a government bureau is not going to be looking just at the data, but at an expected outcome. And that's when we get in trouble. A recent study from the U.S. Chamber of Commerce indicates that risk-based pricing in lending is good for consumers and that credit scores predict risk without bias. The other Ms. Anderson of Equifax, can you discuss why it's so important to have robust credit scores in the credit-based economy, and why is it counterproductive to suppress negative information on your credit reports?
Thank you, Mr. Congressman. I absolutely believe that it's necessary and important to have credit scores in the economy. It's important for us to understand by using access to data and providing that data to lenders so that they can, in fact, make fully informed decisions on extending credit to consumers and extending credit to consumers at the reasonable rates based upon the risk. I also think it benefits consumers. Consumers have the opportunity to get access to credit and to also get access to credit at affordable rates. The access of credit scores in the system allows for consumers to get credit, particularly quick, consistent access to credit that you don't see in many countries. Today, a consumer can walk off of an auto lot and buy a car because of the ability for a lender to have full information and make a yes credit decision. So it's important for us to have a fully functioning credit system with full information.
So you would say that a good credit rating system that mitigates risk is good for the consumers because it helps effectively lower the rates for consumers to increase their buying power. If we didn't have this way of determining who is of greater risk, would you say that the result would be is most, if not all, consumers would then pay a higher rate because they have to make up for the bad debt that would be out there that would be issued by those who didn't pay? Does that make sense?
Yeah, yes, I agree.
Okay. Mr. Danaher, as you know, the alternative data provides major benefits to consumers who previously had little or no credit history. Should Congress pass legislation to expand the types of data included in credit reports?
Thank you, Congressman. Yes, we fully support, the reporting of, alternative data as we're characterizing it, rental payments, utility payments, telco payments, because we believe that greatly expands access to credit. Our analysis shows that maybe up to 60 million Americans who are currently invisible or slightly invisible to the system would become visible. And as you pointed out, lenders want to lend, and lenders will figure out how to lend to those folks once they're visible to the system. So we fully support any efforts for the provision of alternative data to us to expand access to consumers.
So followed up with that are there some improvements that can be made to the system, such as maybe updating credit files promptly instead of the consumer having to wait 30 days for changes to be reflected on their credit report? Do you agree that's a needed reform, and can you elaborate on that?
Yes, I do. I mean, the FCRA and those standards were set, years ago before the great advances in technology, and we do have the ability now to take in data faster, and that benefits consumers.
All right, thank you.
Time has expired. With reference to the ranking member's comment, I do agree that we're having some problems with our timer. In fact, this time we extended more than 6 minutes to the member, but I'll try as best as I can to keep an eye on it, and the staff is working on the problem. With this said, we now have Ms. Adams, the gentlelady from North Carolina, who will be recognized for 5 minutes for her questions.
Thank you, Mr. Chairman, for convening this hearing today, and to our witnesses. Thank you for joining us as well. The role that our credit bureaus play as consumer credit report databases is critical both to lenders, but especially to borrowers. A borrower's credit report could mean the difference in getting affordable capital or being forced into a more expensive product or not receiving credit at all. It's been more than 15 years since Congress has enacted comprehensive reform of the consumer reporting system, and it's widely accepted that the current system has numerous shortcomings that need to be addressed. And that's why I'm planning to reintroduce my bill, the Improving Credit Reporting for All Consumers Act, that would improve the dispute process for consumers, place better requirements on furnishers to retain records on consumers, and provide consumers greater transparency regarding the documents used to determine the accuracy and completeness of disputed items. So we must do all that we can to ensure that consumers are fully knowledgeable about their options and have necessary resources available to them to ensure that their financial health and well-being is secure. Mr. Anderson and Mr. Danaher, I believe that you all would agree that maintaining accuracy, completeness, transparency, and access at the bureaus is very important. Since the FTC's study of credit reporting accuracy nearly a decade ago, there have been no broad-based public analysis of the accuracy of and the error rates for consumer credit reports. And I hope that you will help us to better understand understand what those error rates look like. So can each of you, to the best of your knowledge, tell the subcommittee the error rates in your consumer credit reporting products with regards to each of the following categories of information: trade lines, collections, inquiries, consumer identifying information, and public records? Yes, did you all hear the question? Hello?
We heard you.
Oh, okay.
To whom are you addressing your question?
To both to Ms. Anderson and
all right, we'll start with Ms. Anderson. Ms. Anderson, would you
and
kindly
Mr.
respond?
Danaher.
You
There
may
are
be
two
on
of us,
mute.
which Miss Anderson.
Oh, okay. Oh, both Andersons and Mr. Danaher.
So I would agree. I'll step in and go first. I would agree. Accuracy is very, very important, and shared my perspective a little bit earlier. And I think there is a ton of work that has been done across the years with furnishers, clarifying the reports, bringing data accuracy into being. But I also believe that there is more work that we can do as we all work to ensure maximum accuracy. The data that you're asking for would be happy to follow up with, but just wanted to acknowledge that I completely agree.
Right, okay.
Thank you.
Well, that would be fine if you all would send that to us in writing. So do we have any other responses, or can you all just send it to us in writing? So let me ask you, if you do track these error rates, what are the metrics used to track accuracy and the error rates in the consumer data used in your products, and the frequency of such tracking? And Mr. Danaher, what about you?
Thank you, Congresswoman. I mean, we track those in two ways. So one is we look at all of the disputes that we get from consumers and determine which, what the cause of the error was. And as Ms. Anderson pointed out, we can get you that by category, so we can follow up and report that data to you. The other way that we track it is looking at what data furnishers provide us and error rates by data furnisher. So if we find that we're getting disputes from consumers at higher concentration from a particular data furnisher, we work with them to try and correct it. If it can't get corrected, as Ms. Anderson pointed out, we have the same process. We will prevent that data furnisher from reporting data to us. So we have statistics on both sides of that.
Okay, good enough. Let me ask Ms. Wu, do you feel that a new broad-based public analysis of the accuracy of and error rates for consumer credit reports would be warranted to update the important work the FTC undertook a decade ago?
Ms. Wu, before you answer, please allow me to intercede. We are beyond the 5 minutes. We'll receive Ms. Wu's answer, and then the chair will have to move on to the next witness. The timer that we have, as Mr. Barr has indicated, and I agree, is inaccurate at this time. So Ms. Wu, if you'll kindly answer, please.
Yes, of course. Thank you, Chair Green, and thank you, Congresswoman Adams. I certainly agree that more data is always useful. If there's to be a study, it needs to be started right now, because it took the FTC 10 years to do that study. It's incredibly intensive. With respect to the furnisher reports that Mr. Danaher mentioned, they do have reports on different furnishers and how accurate they are. And this committee may want to ask for those reports, because that gives one indication of accuracy. And of course, the other indication is the massive number of complaints to the CFPB. Thank you.
The gentlelady's time has expired. The chair will now recognize Mr. Mooney for 5 minutes for questions.
Thank you. Thank you, Mr. Chairman. Look, these credit reports give lenders an insight into how likely a borrower is to pay back a loan. If the potential borrower has an incomplete credit history or a history of poor credit, then the prospect of payback is less certain. This results in higher pricing or even an unwillingness to extend credit at all. In other words,
Mr. Mooney, would you please check to see if you have muted yourself? Mr. Mooney, we cannot hear you. Would you please check again to see if you've muted yourself?
okay, it's not on mute. Can you hear me now?
We can hear you now. Thank you. And I will extend your time by 30 seconds.
All right. Way to measure uncertainty. The more uncertain the loan, the higher the price to compensate for the risk. So, Mr. Danaher, can you please tell us what would happen to the cost and availability of credit if we were to suppress adverse information on credit reports?
Thank you, Congressman. I think two things would likely occur in that case. One is the cost of credit would increase as lenders priced, as you say, for the unknown, for the risk. And secondly, I think there would be a contraction of credit. Lenders would be less willing to lend to marginal borrowers because they would, not have that insight into exactly how that borrower might perform. So I think that risk-based pricing does result in lower prices for many consumers, but it also greatly expands the universe of potential borrowers because you're able to price appropriately for risk.
Got it. Next question for Miss Kuehn. Your testimony listed past instances when either legislative or regulatory changes led to improved accuracy on consumer credit reports. Do you have any policy recommendations to improve credit report accuracy going forward?
Well, we've seen a lot of work going on these last few years, particularly with the advent of the Consumer Financial Protection Bureau. This was the first regulator with examination authority. So whereas the FTC could investigate issues of accuracy, the examiners at the CFPB are down there daily, looking at the operations of the consumer reporting agencies and working with them to find ways to improve accuracy. This is an ongoing process that frankly is usually outside of the public view and has made a lot of strides in improvements to the processes and systems. This is why the CFPB announced recently that they intend to undergo a new study on accuracy since it's been so long since the FTC study, and are going to look at different methodologies, hopefully faster than the 10 years that Ms. Wu referred to be able to conduct the study on this and look for these improvements.
Okay. Thank you, Mr. Chairman. I'll yield back the balance of my time.
Gentleman yields. The chair now recognizes the gentleman, Mr. Garcia from Illinois, for 5 minutes of questions.
Thank you, Mr. Chairman and ranking member, and thanks to all the witnesses. The reality is that people in working class communities like mine and the district I represent worry a lot about their credit score. It's hard enough to rent an apartment, get a job, or buy a house, and a low credit score can lock people out of building a better future for themselves and their families. In normal times, it's concerning. But right now, while Congress and the White House are focused on building back better and promoting an equitable recovery from the COVID-19 pandemic, these barriers are a real policy problem. We talk today about the inadequacy of the dispute resolution process at the credit rating agencies. An error on someone's credit report can wreck their financial future. But existing dispute processes are too automated and frequently side with the lender or furnisher instead of the subject of the report. We've known this problem for years. A question of the representatives from Equifax and Experian. Have your companies worked together to address issues in your dispute resolution process? And please be mindful that the clock is running pretty quickly here. Equifax and Experian, please.
The dispute process is a very important process for consumers, and we have 3 ways that a consumer can engage with us around disputes. An online dispute process, which gives them the ability to track exactly where the dispute is. They can dispute by our contact centers and by mail. We work directly as an intermediary with consumers as well as with furnishers to do our best to rectify and resolve that dispute quickly. We actually have the ability, if we have the right information, to resolve a dispute and assist a consumer without going through the furnisher. We also can work directly with the furnisher through investigations. You know, in 2015, we agreed with the other bureaus to work together to share cross information on disputes so that we do actively compare and contrast notes and information so that we do a very good job on behalf of the consumers. I look forward to additional work.
Ms. Anderson, can we let Sandy Anderson also take a crack at that?
Yeah, thank you, Congressman. Similar to what Ms. Anderson at Equifax stated, we have similar processes. We continuously look at how do we improve the dispute process, allow consumers to reach out to us in their channel of choice. And we also look for ways that we can resolve that dispute directly with the consumer and or going to the data furnisher.
And have you discussed implementing stronger standards across the industry to help decide when to investigate a claim made by a furnisher?
You know, as Ms. Anderson referenced, our cooperation under the NCAP agreement allowed for us to make improvements there, and we continue to look at how do we do that as an industry.
Okay, Ms. Wu, do you think that the industry takes dispute resolution issues like parroting seriously? Can companies improve the dispute resolution process themselves, or do you think that an independent body or stronger standards would help consumers straighten out issues?
Thank you, Congressman Garcia. I think we need an independent body. The incentives are always for the credit bureaus to side with the furnishers. Those are their customers. The idea that there's any competition for consumers, it doesn't exist. If I'm unhappy with Equifax because they gave my data away in the Equifax data breach, I still can't walk away from Equifax. We need an independent body, either an ombudsperson at the CFPB and FTC, or ideally a public credit registry, because their incentive is just to sell this data, and as much as possible, a public credit registry would give us a lot more control. And just one more thing on this risk-based pricing issue, just remember, risk-based pricing caused the mortgage crisis of 2008-2009.
Thank you very much. No further questions. I yield back, Mr. Chair.
Gentleman yields back. The chair will now announce that Mr. Kustoff of Tennessee will be heard for 5 minutes of questions. Mr. Kustoff, you're recognized.
Thank you, Mr. Chairman, and thank you for convening today's hearing, and I thank the witnesses for appearing. If I could, we know that identity theft and breaches, of course, been well covered by this committee. And I think one thing that all 3 of the credit reporting agencies recommend is for individuals that they choose to do it are credit freezes. And I will say to all of your credit, I think you've made the process of requesting a credit freeze safe. You've made it reliable. And, while there are a number of checks and balances, it can be done fairly expeditiously. Mr. Danaher, if I could to you, the same is probably not true for children. In other words, those under 18 years of age. My question to you is actually two questions. One is, when would you recommend a credit freeze for a child? And then secondly, what, if anything, can be done by your agency and others to make the process easier to request a credit freeze for a child? And that's to Mr. Danaher.
Oh, thank you, Congressman. Sorry, I didn't hear that. Yes, we believe the process for adding a credit fees to a minor's credit file or preventing a credit file from being opened for a minor until they're of age, I think it's 16 on our system, can be made easier. And we are currently wrestling with that right now. The issue for us is proving who can set a freeze for a minor. In other words, verifying the identity of the person trying to set the freeze. So whether it's a parent, guardian, et cetera, like knowing the relationship between the person trying to set the freeze and the minor can, currently right now we have to ask for documentation on that, and people submit manual documentation so that we can verify that it's being set by the appropriate person. But we are looking at ways to automate that and make it easier for parents, guardians, et cetera, to protect the identities and the credit files of their minor children.
If I could, to Ms. Anderson of Experian, I'll ask you the same question. Is there an easier way? Is there an easier process? Are you looking at an easier process to place credit freezes on the benefit of children?
Yeah, there's always room for process improvement, and we certainly take that seriously and continue to look at it. But just as a reminder that the display of anybody under the age of 18 is blocked. So that information would not go out of our systems, even if it was in the system of record.
Wouldn't the children still be at risk of identity theft if the record was not frozen?
There's always risk of identity theft with fraudsters getting access to personal PII. But again, getting access of that data from our systems when we don't release that data until they're 18.
Thank you, Ms. Anderson. And Ms. Anderson of Equifax, if I could ask you a different question. I'm referring back to your written testimony. You do note that the credit scores during COVID hit a historic high. I think you said it was around 710 or 711, and you've cited some of the reasons. Do you all at Equifax, do you project over the next 6 to 12 months whether that trend will continue?
Well, certainly we did in fact see credit scores improve over the COVID timeframe, and believe that as long as the consumers have access to the kinds of protections that we've seen during the CARES Act, we imagine that behavior could in fact improve. Of course, I don't want to sit here and forecast what the future looks like, but certainly we believe that the economy is recovering. Consumers feel positive about where things stand relative to COVID. Jobs are starting to return, so we definitely feel positive.
Thank you, Ms. Anderson. Thank you, Chairman.
Yes, the gentleman's time has expired. The chair has an announcement. The chair will step away, and in the absence of the chair, the gentlewoman from Georgia, Ms. Williams, the vice chair, will assume the position of chair. I have Madam Vice Chair, Ms. Garcia of Texas next, thereafter Mr. Timmons of South Carolina, and thereafter you would recognize yourself for 5 minutes, and Perhaps I will be back before that time, but if not, you'll recognize me after you have recognized yourself. I yield now to Ms. Garcia of Texas for 5 minutes, and Madam Chair, I shall return.
Mr. Chairman and Madam Chair now, thank you for bringing us to talk about such an important issue. This is an issue that I've cared a lot about going back to my legal aid days when I had occasion to call the National Consumer Law Center. And I can say that they were always very helpful in getting through some of our client issues. Credit scoring is a fundamental part of our economic system. A person's credit score determines their access to into our financial marketplace. As I've said many times before, access to credit means access to building wealth. This system is founded on the idea that it is fair and accurate, but recently we found a series of problems with disputes and inaccuracies. While I realize that sometimes these things do happen, it is important that we get to the bottom of this to ensure that it doesn't happen to the degree that it hurts our consumers. Mine is a working class district. Many people in my district as consumers don't understand the processes of the consumer credit agencies. They don't understand what credit scores mean. So it really keeps them away from the marketplace. Ms. Wu, I wanted to start with you. You told us some of the stories, and in my district, because it is a 77% Latino district, very high Spanish speaking, limited English literacy. Can you describe the barriers faced by those who prefer a language other than English? And more importantly, what legal framework exists to protect those who are subject to even more information challenges than the average consumer?
That's a great question. Thank you, Congresswoman Garcia. The fundamental problem is this: credit reports are not available in languages other than English. We have sent letters to the credit bureaus asking them, please translate the credit reports. It should be easy in this day and age of automated translation and then having someone go through it to check everything. And we got a big fat no from the credit bureau, from CDIA, that they wouldn't translate the credit reports. How are you supposed to monitor and keep track of your credit, check for errors and disputes if you can't even read the information? Equifax, to its credit, did say they're looking into it, but otherwise, big fat no.
Well, let's ask each one of them. So, Ms. Is it Sandy Anderson? Is it true Equifax is thinking about it or is already doing it?
So I represent Experian, Congresswoman, but for us, we currently don't offer credit reports in any other language other than English today. We do have Spanish-speaking agents that consumers can reach out to and discuss their credit report and questions. So we do provide that. We also work with different community groups that provide financial education services in the consumer's native language.
All right, now let's ask the other Anderson.
Thank you, Congresswoman. We are very close to launching our first Spanish credit report. We're excited about the work that we've been doing there. In the meantime, we have Spanish agents in our call centers and translation language vendors who help us when we have consumers who need additional support from a language perspective.
Right, and the last one, Mr. Danaher.
Congresswoman, we do make credit reports available both in English and Spanish. We also have Spanish-speaking customer support agents who will answer any questions somebody may have in Spanish. As we talked about when we met earlier this week, we were also looking at prioritizing other languages and trying to figure out what the demand might be for consumers to see their data in languages other than English and Spanish.
Right, because to Ms. Talib's point earlier when she was asking some questions, there are studies that have found that there is disparate treatment of minorities, and certainly the recent complaint bulletin that was issued by the Consumer Financial Protection Bureau just April of 21, just last month, clearly showed that in 2020, the CFPB received more complaints per capita from consumers living in predominantly minority counties. And from 2019 to 2020, complaints increased at a greater rate in predominantly minority counties compared to predominantly white non-Hispanic counties. I mean, it's there. We've got to do something to do better. And with that, Madam Chair, I know my time is running out. I want to ask unanimous consent to submit for the record a copy of the complaint bulletin outlining some of the items that I just mentioned. With that, I yield back.
Ms. Williams, will you please take the chairman's chair and the gavel?
Thank you, Chairwoman Waters, and thank you, Ms. Garcia. And your questions will be submitted for the record.
Right. So my document is approved for the record?
Yes.
Without objection.
Without objection, Ms. Garcia.
Well, thank you, ma'am. I yield back.
The chair now recognizes Mr. Timmons from South Carolina for 5 minutes.
Thank you, Madam Chairwoman. First, I want to point out that risk-based pricing definitively did not cause the financial crisis of 2008. In fact, it was the absence of accurate risk-based pricing, the distortionary influence of government policies subsidizing credit in ways that concealed the real credit risk that encouraged lenders to put people in homes with mortgages they couldn't afford. I just wanted to begin with that. So now I have an actual question. Given the data breaches in the past, and particularly the ransomware attack involving Colonial Pipeline, I would imagine cybersecurity is top of mind for your institutions. Can you describe the increased security posture you all have put in place after the Equifax breach, and briefly describe your efforts to make sure that all consumer credit information is kept safe and secure? And anyone that wants to answer that?
Why don't I start, since you referenced the Equifax breach?
Okay, thank you.
Thank you for that question, Congressman. I would like to say that Equifax is certainly focused on security and believe that the work we have done over the course of the last several years puts us at the forefront of being an industry leader in security. We've spent $1.5 billion over the last 3 years delivering top-notch security and IT infrastructure into a cloud-native environment, and multi-millions of dollars creating a security response and monitoring system. We've hired a number of cybersecurity experts in our company, and we've made security a core tenet to our culture as a company. Most recently, we produced a report sponsored by a security expert called Brightsight that indicated that our company is in the top 3% of security of the top 1,000 largest U.S. firms. So we're excited about the work we've done to secure our customers and our consumers' data.
Sure, thank you for that. And I'll open this up to anyone else. My second question is going to be about the increasing patchwork framework of data privacy and security regulations at the state level across the U.S. Are your companies concerned that privacy and security compliance costs are going to increase? And would you prefer Congress to preempt states to create one nationwide standard?
I'll take that one. Thank you for the question. A nationwide standard would make it easier to figure out when consumers need to be notified in the event of a breach. But all of the consumer reporting agencies comply with federal standards for data security to ensure the security of information no matter where consumers are located.
Sure, thank you. Would either Experian or TransUnion want to weigh in on that as well?
Thank you, Congressman.
Oh, sorry, Sandy.
Yeah, we would support a federal privacy law.
Congressman, yes, we agree too. It's easier for us and more productive to manage to one standard rather than 40 or 50.
Sure, no, thank you. And I'm interested in, when you consider your cybersecurity budgets, do you also include the compliance costs associated? I don't want to get into that right now, but we might send some follow-up questions. I'd love to understand more, because I think that when considering your cybersecurity budget, that should be a part of it. And when you have to hire an army of attorneys to comply with all the various privacy and data security regulations, it really it adds up a lot. So I appreciate that. So real quick, before I close, I do want to respond to the gentlewoman from Michigan, Ms. Tlaib, who was litigating the practice of auto insurers using credit scoring data in their underwriting. The average auto insurance rate in Michigan is $2,300 a year versus just $1,500 a year in South Carolina, where this underwriting factor is used. Insurance is a highly regulated business on the state level. South Carolina knows best what our market and consumers need, not Congress, and definitely not anyone from Michigan. With that, I yield back. Thank you.
The gentleman yields back. The chair thanks the vice chair for standing in my absence. And now the chair is honored to recognize the vice chair for 5 minutes for questions. Ms. Williams.
Thank you, Mr. Chairman. According to a recent CFPB Consumer Complaint Bulletin, consumer complaints rose across the board between 2019 and 2020, but at an even faster rate in predominantly non-white counties. Earlier this month, I authored and passed an amendment on the House floor that will study this kind of disparity and provide policy recommendations to ensure greater equity. Ms. Wu, how important is it to analyze and address racial disparities to advance the broader goal of creating a more consumer-friendly financial marketplace?
It's absolutely critical, and it's probably the most important issue facing credit reporting and credit scoring, the fact that there are vast racial disparities in credit scores. The Urban Institute found that more than 50% of white households have a FICO score above 700 compared to only 20% of Black households. That is why risk-based pricing hurts Black consumers more. That's why these practices of using credit scores for auto insurance hurts Black consumers more. And that's why errors affect minority communities more, because folks who have lower credit scores are more prone to errors in their credit report. And that makes sense. If you have an 800, that means you have a perfect credit record. You're not going to get errors. And so the racial disparity should be top of mind, anybody who cares about racial justice.
Thank you, Ms. Wu. Also in your testimony, you mentioned how important it is to take the pandemic's impact into account when it comes to negative credit reporting. Currently, the law provides that a federal student loan borrower's credit score can't be negatively affected if they miss a federal student loan payment during the pandemic. But this protection was made possible with bipartisan support. I recently worked with my colleague, Congresswoman Alma Adams, to pass an amendment to provide student loan borrowers the same relief that from private student loans. How would providing all student loan borrowers equitable relief and credit reporting during the pandemic help everyday folks who've experienced financial disruption and are struggling to get back on their feet?
It certainly would help. Borrowers with private student loans should have the same protections as borrowers with federal loans. And in fact, the CARES Act protection didn't even cover all borrowers with federal loans. And so it's important that all of them got relief given the economic dislocation caused by the pandemic. I also note that slipping through the cracks definitely happened with federal student loan borrowers. There was a lawsuit against one servicer, Great Lakes, for messing up the credit reporting. That's why we had advocated for just a negative moratorium on pandemic-related, on negative information during the pandemic because of the severe nature of the economic dislocation. The CARES Act provisions are complicated, and we've definitely seen a lot of creditors mess up on them. That's actually what the slipping through the cracks that Ms. Beverly Anderson warned about has been happening.
Thank you so much, Ms. Wu. And with that, Mr. Chairman, I yield back.
The gentlelady yields, and the chair now recognizes Mr. Gottheimer for 5 minutes.
Thank you, Chairman Green, for allowing me to attend this important hearing, and thank you to our witnesses for being here today. The United States is the most credit fraud prone country in the world. Every year, 15.4 million Americans are victims of credit card fraud, or around 42,000 people every single day. The FTC has found that 1 in 5 consumers have verified errors in their credit reports, and 1 in 20 consumers have errors so serious that they'd be denied credit or forced to pay higher interest rates. That adds up to 42 million Americans with errors in their credit and another 10 million with errors that can be life-altering. Scams typically increase during times of crisis, and the COVID-19 pandemic has been no exception. As the nation works into the economic recovery from the recession brought upon by the crisis, I think we can all agree that it's more important than ever that all Americans have equal and just access to credit. Ms. Anderson, early into the pandemic, your company, Experian, joined TransUnion and Equifax in announcing that Americans would be able to access their credit report for free on a weekly basis. Knowing that Americans would be under significant stress from keeping their families and communities safe and worrying about their jobs, why did your company still choose not to give Americans unlimited free access to their reports?
So as you stated, Congressman, thank you for that question. We do provide access to free credit reports on a weekly basis as an industry. Experian also provides free credit monitoring, free access to credit reports, and free credit scores to over 40 million U.S. consumers today. And we continue to grow that as consumer needs rise.
Got it. So you're doing exactly what TransUnion and Equifax offers?
I can't speak for the other two, but certainly Experian is expanding our free offering to consumers.
So during the pandemic, everyone's been able to access their credit free on a weekly basis?
Correct.
Okay, that's good. Ms. Wu, you've been concerned, particularly during the pandemic, about credit issues and Americans having access to information about their credit? For Ms. Wu?
Hi, this is Brian.
Yeah.
Hello.
What we've been concerned about is the impact of the pandemic on consumers' credit reports and their credit records, especially debt collection items. So, we have heard that scores have stayed flat and risen. It's due to a number of things. One is the fact that you've got a K-shaped recovery. So if you have some scores that go up and some scores that go down, on average, you may get the same scores or a slight uptick. But what I'm worried about is the 8 to 10 million renters who are facing eviction, who may then face debt collection items for back rent. That's going to hurt their credit reports. Medical debt. A lot of people lost their employer-provided health insurance. When you get medical debt, you get debt collection items. They show up in your credit report. They hurt your ability to get credit, get housing, get employment. So these are some of the things I worry about. I do commend the credit bureaus for providing credit reports once free per week. I think it should be permanent. I think you had a bill last year that would provide something similar to that, and I think it's a great idea.
Thank you so much. I'm glad we got to have gotten a chance to work together on these issues. Do you agree that we should make it easier for Americans to get their information for free and initiate disputes when it comes to credit, given how important this credit information can be on every aspect of people's lives, from what they pay for insurance to their mortgage, you name it, it seems to be affected by people's credit scores?
Absolutely. It should be easy and it should be fair. Easy should mean not just the credit reports, but the scores, because you need this credit scores to know where your credit standing is. And it shouldn't be just the one credit score. It should be the credit score that lenders use the most often. It should be other risk scores. The credit bureaus are developing all these new products and these new scores that judge consumers. All of those should be available, not just the regular credit score, but healthcare scores, fraud risk scores, tenant screening scores. And then fair. When you dispute, you should be able to get a fair determination and not always side for the furnisher. And that's why the ombuds concept in your bill last year was so important, to give CFPB the ability to be the referee when the consumer disagrees with the results.
Exactly. I think you're referencing the Protecting Your Credit Score Act. It creates an online portal, to provide Americans with free and unlimited access to their credit reports, credit scores, credit freezes, the ability to dispute errors and fraud, and the ability to secure and track their credit data, all about transparency to help Americans boost their credit and financial security through economic declines and beyond. It's clear we still need this legislation, and you're making a great point about making sure that it's all the scores, not just one, so they can't create other ways around it. So thank you so much. I thank the witnesses for being here today. Thank you, Mr. Chairman.
The gentleman's time has expired. The chair now recognizes himself for 5 minutes for questions. Permit me to ask the witnesses to comply in the following fashion. I shall pose a question, and I will ask that you simply raise your hand if you understand the question as I have posed it, or if your answer is to be yes or no, and I'll be sure to be clear as to whether I want you to raise your hand if it's yes or no. Let me ask first, and I assume that you are very much aware of this, given that you're at the hearing. Were you aware of the style of this hearing today? The style is consumer credit reporting, assessing accuracy and compliance. Were you aware of the style of the hearing prior to coming today? If so, would you kindly raise a hand? Thank you for it very much. Let the record reflect that all the witnesses were aware of it prior to today. Now, is it true that as a major business, you maintain records so that you can ascertain the accuracy rate that you have within your business? If you believe that as a major business you should do this, would you kindly raise your hand? Maintain your accuracy rate. All right, I see one hand. I don't see the third hand. Ms. Sandy, did you? Oh, I see. Oh, thank you very much. All of the witnesses agree that they should maintain an accuracy rate. Would you kindly now tell me what your accuracy rate is? Let me start with you, Ms. Sandy Anderson.
Thank you, Chairman. We track a number of metrics to determine accuracy rate, and right now we're tracking at over 99%.
And what metric is that?
That's our accuracy metric that we use to track material errors in credit reports as they're used by lenders and consumers.
Well, I'm to understand that with reference to your errors, you are 99% accurate in terms of the information that you provide.
Correct.
All right, thank you very much. Let's go to Mr. Danaher. The question is the same to you, sir.
Mr. Chairman, our analysis shows that credit reports are 98% accurate with regard to material accuracy. So 2% errors or so of credit reports are inaccurate with material consequences for the borrower.
Thank you. Let me move now to Ms. Beverly Anderson.
The last accuracy data measured by the CFPB happened in 2012. We know that there is another report that they would like to have to update the accuracy data, and we welcome this study. We have a number of measures in our business that measure the accuracy of our data furnishers, the level of dispute.
Ms. Anderson, if I may intercede, Ms. Anderson, I'll have to intercede. I need to know what your accuracy rate is. You've acknowledged that you knew what we were going to discuss today, and your 2012 data probably is a little bit outdated, but what is your accuracy rate, please?
Our data will be similar to the other two bureaus.
What does similar mean in terms of a number, please?
I'll have to get back to you with a number.
I would ask that you do so and express my dismay that you're not prepared, given that you were well aware of the style of this hearing and what we'd be asking. Let me go on to something else that's exceedingly important. Minorities seem to have higher inaccuracy rates or error rates than others in this business. Do you keep a record of the accuracy rate as it relates to minorities? Let me start with you, Ms. Anderson. Do you keep such a record? Beverly Anderson. Ms. Beverly Anderson, can you hear?
Yes, I can. Yes, thank you.
Do you keep such a record? And I'll ask that you respond.
We do not. Yes, we do not have race data on our file.
Let me move on to Mr. Danaher.
No, Mr. Chairman, we don't have any insight into the race of the people on the credit file with regard to accuracy.
And then Cindy Anderson.
Thank you, Chairman. No, we don't have race data in our credit file.
As time has expired, let me thank the witnesses for their testimony. and for devoting the time and resources to share their expertise with this subcommittee. Your testimony today will help to advance the important work of this subcommittee and of the U.S. Congress. The chair notes that members may have additional questions for this panel, which they may wish to submit in writing. Without objection, the hearing record will remain open for 5 legislative days for members to submit written questions to these witnesses and to place their responses in the record. Also, without objection, members will have 5 legislative days to submit extraneous materials to the chair for inclusion in the record. I remind members to submit written questions and materials for the record to the email address provided to your staff. I would also, while it is after the fact and a little bit late, remind members that we are not to address our comments to other members, but rather to the chair. With this said, this hearing is now adjourned.